Hello everyone and welcome back to the channel. This is Fair Value Finder and today we're taking a look at another requested stock, HF Sinclair, ticker DINO, D-I-N-O. This stock clearly trades at a discount to its fair value. We have only barely gone above the margin of safety buy range with a fair value around $82, just shy of that, and that would give us a margin of safety around $69.50. And the peak of this stock was back in 2018, $72.55. It's gone down and finally kind of bounced in late 2020 and has been on a uptrend since then, hitting a peak $63.36, and it currently sits just shy of $47. We can go back pretty far with this stock. It came out in 1987, and we see it's just got a long, slow growth, moving from a low of 4 cents all the way up. It has its ups and downs, but pretty consistently it's gone up, just like the rest of the market. So let's take a look at these numbers and see why this stock might be trading at a discount to the fair values. So here we have the numbers. Again, I have everything broken down on individual sheets that we can take a look at, but the orange is the important stuff that we need to look into and get a little summary of the stock. So revenue have been growing it nicely, almost 30% year over year over the last 3 years, 84.83 over the last 2 years. That's nice and strong. Analysts are expecting a bit of a drop this year, moving from 38.2 to 29.86, and moving forward, get back up above 30.34. So that trend is expected to be broken. We'll see how they come in, though. Expenses as a portion of revenue, we want to see declining. So we have 91.8, 101.7, 95.9, 89.4. Kind of, it's mostly stagnant. So they're not doing a whole lot. Like their expenses are essentially increasing at the same rate as their revenue is, which can definitely run into trouble when you see a decline in the revenue. And then as for earnings, they've grown those very nicely too, moving from $4.64 to $14.28 over the last 3 years. But that is expected to drop, just like the revenue, to $7.61 this year and $5.94 next year. The earnings yields do look good across the board. And aside from 2020 was clearly a bad year. And 2022 was clearly the best year, which is a trend that we've seen in quite a few stocks. The share count, they have been growing their share count. They were decreasing it 2019, 2020, 2021. It was going down, and it saw a very large uptick in 2022. So that is something to keep an eye on. Hopefully they start decreasing it again, but the fact that they did that is already a red flag. Shareholders' equity has been increasing. Free cash flow has been increasing. And their free cash flow yield looks decent last year. It's honestly not the best. 2019, it was decent. I mean, we're looking for something above 4.5%, and this year it's not projected to do that based on how it's typically done. Assets, they have been growing the assets 14.2%, liabilities at 12.7%. So we have a tangible book value that has been increasing nicely because a lot of their asset growth has been intangible assets. Debt to equity ratio is shy of 1, which is good, and they have been kind of stagnant with that as well. I mean, it's been around 1 for the prior 3 years. So last year was the only time that we really saw movement. The dividend, from what I see, they didn't start paying a dividend until 2021. And it was 40 cents 3 times throughout the year. This year, they're expected to do 45. So I'm just projecting that 5-cent increase out into the future. And that will give us our values down here. ROE looks okay. It's kind of towards the lower end this last year. Not good any other year. I mean, we want at least a 20. As for the fair value, we see most of the values coming from the cash flow last year. This year, it's actually mostly coming from the balance sheet, followed by the cash flow, dividend, and the earnings. A lot of these numbers are pretty close. I mean, these two are around the $100 mark. We end up with a fair value around $83, and that'd give us a margin of safety 70.47, and then it'd be way overvalued at 91.62. According to the Peter Lynch formula, this stock is undervalued due to the insane growth that it's seen here. It's definitely not projected to keep it up. It's going to be almost cut in half this year. And we will see what that does to the stock. So here's the easiest way to actually see growth. Again, we want to see these, the gaps here widening, and we do see that in 2022. 2023, we'll see how they come in for the full year. For the gross profit, net profit, and EBITDA, we really want to see the net profit getting closer to the gross profit. And we do see consistent correlation between the two of them. Maybe in 2022, again, it really spaced out. So the only good year, like really good year that I see here is 2022. In fact, Benjamin Graham had a rule, and I personally have a rule as well, where if they came in negative in earnings or net income, EBITDA, any year in the past 3 to 5 years, it's not to be touched. And so this is going to take 1 to 2 more years before I would even consider giving it a buy. It's got some undervalued potential. I like the growth that it was experiencing. I mean, really, 2022 was the only great year with any decent growth here. Assets and tangible assets. We see that we got some nice growth across the board. Liabilities and tangible book value. We see some growth in the liabilities that we really don't want to see. We want to see that more stagnant, if not declining, but at least the tangible book value is growing very quickly, definitely outpacing. Cash flow, a negative year of cash flow in 2021. So that means that I wouldn't even consider this until 2025. And there's no story here. It's a story of decline going into 2021 and a good year in 2022. And then as for dividends, like I said, they started paying in 2021, and we're hoping for a 5-year or 5 cent a year increase. But that's what I'm seeing for this stock. It's probably a hold. It's not a sell. It's not completely undervalued. There is no massive red flag decline. The fact that the share count has grown definitely does not allow it to be a buy, and the negative free cash flow and earnings within the last 3 years disqualify it as well. It's definitely an interesting stock. I'm sure if you were to buy it today, you'll make some sort of profit, but it doesn't meet the quality and consistency standards of a good value stock. It gives you a good look at the company and their fundamentals, why they might be trading at a bit of a discount, because 2021 was the only good year here that we see. I mean, outside of that, moving from 17.5 to 18.4 over a 2-year period is nothing super crazy. And even in that revenue growth, they saw a decline in the earnings. So I'm not surprised with what I'm seeing in the chart. What we're really looking for a value company would be they are just fundamentally undervalued, but they're showing good, strong growth across the board and consistency. And this isn't one that's showing that. So thank you guys for watching. Please like if you learned anything. Please let me know what other stocks you want to take a look at, and subscribe if you want to see more like this. And I'll catch you guys next time.